Precious metals markets open the new trading week on Monday, the 9th of March, 2026, with silver recording a decline in early trading. The spot price of silver, which closed at $84 on Friday following a significant rally, moved lower to $83.35 within the first 90 minutes of the Monday session. That opening movement represents a 65-cent decline from Friday's closing price and has drawn attention from market observers tracking both the paper futures market and underlying physical supply conditions. On the energy front, Brent crude oil spiked to $119.70 per barrel overnight before settling above $100 at the time of reporting. The Strait of Hormuz, which handles 21% of global petroleum traffic, is reported to be effectively frozen due to ongoing military escalations in the region. In response to conditions in global energy markets, the G7 held an emergency meeting at 3 o'clock in the morning Eastern Time to discuss the coordinated release of strategic petroleum reserves. The source report identifies a direct relationship between energy prices and silver mining production costs, citing Fresnillo as one of the largest primary silver producers in the world. According to Fresnillo's most recent quarterly earnings report, the company's all-in sustaining cost was approximately $21 per ounce, calculated during a period when Brent crude oil averaged $78 per barrel. The report identifies energy as representing approximately 30 to 35% of Fresnillo's total cost structure when accounting for diesel, fuel, electricity generation, and transportation, equivalent to approximately $7.35 per ounce, directly tied to energy prices at the time of that reporting period. With Brent crude having moved from $78 to above $100 in less than 72 hours, a reported increase of 28%, the source report calculates that the energy cost component of Fresnillo's production cost per ounce has increased from $7.35 to approximately $9.40. Under that calculation, the report states that Fresnillo's all-in sustaining cost has moved from $21 per ounce to approximately $23.50 per ounce, using the settled price of $100 for Brent crude as the basis for the calculation. With silver opening lower on Monday morning, against this backdrop of rising energy costs, emergency G7 meetings, and ongoing Strait of Hormuz disruptions, the detailed mechanics underlying both the paper market movement and the physical production cost equation warrant closer examination. To understand the relationship between rising energy prices and silver production costs, it is necessary to examine the specific stages of the mining and refining process through which energy expenditure is incurred. The source report outlines this process in detail, identifying energy consumption at each stage of silver production, from extraction through to final delivery. The first stage involves diesel-powered excavators digging ore from open-pit mine sites. The extracted ore is then transported by diesel-powered trucks to processing facilities. At the processing stage, ore is crushed into fine powder using grinding mills powered by electricity, which in most mining regions is generated through the combustion of natural gas or coal. The crushed ore then undergoes a flotation process, requiring heat, water, and chemical reagents to separate silver from base metals. The resulting concentrate is subsequently smelted and refined into pure silver bars, using furnaces operating at temperatures above 961 degrees Celsius. Refined bars are then transported across ocean shipping routes on cargo vessels burning bunker fuel. The final stage involves storage and distribution through a logistics network running on diesel and electricity. The source report identifies every stage of this sequence as denominated in energy costs, presenting the mining production chain as fundamentally dependent on energy at each step, from initial extraction through to final delivery at the retail distribution level. On the specific cost calculations outlined in the source report, Fresnillo's reported all-in sustaining cost of $21 per ounce was based on a Brent crude average of $78 per barrel during the relevant reporting period. With energy representing 30 to 35% of total production costs, the isolated energy component per ounce is calculated in the report at approximately $7.35. Applying the reported 28% increase in Brent crude, from $78 to above $100, to that energy component produces a revised energy cost of approximately $9.40 per ounce, raising the total all-in sustaining cost to approximately $23.50 per ounce at the $100 oil price level. The report further notes that if oil returns toward the overnight high of $119.70, the energy cost component would rise further. For producers operating on long-term fuel contracts and electricity rate agreements forecast 6 to 12 months in advance, the report states that those caught by the energy price increase would face cash flow losses on each ounce produced until contract renegotiations are completed. The report estimates that renegotiated energy contracts during a geopolitical oil shock would carry a significant premium, potentially pushing real all-in sustaining costs for affected producers to between $26 and $27 per ounce for large-scale efficient operations, and above $30 per ounce for smaller producers operating at higher baseline costs. The source report also addresses the structure of the COMEX silver futures market and its relationship to physical silver supply. A standard silver futures contract on the COMEX represents 5,000 ounces of silver. At a price of $84 per ounce, the notional value of a single contract is $420,000. Margin requirements allow traders to control that contract by posting approximately 10% of its notional value, roughly $42,000. The report states that the volume of contracts traded during the opening period of Monday's session did not correlate with physical silver changing hands, noting that the COMEX has publicly stated that less than 1% of contracts result in actual physical metal delivery. The report characterizes the COMEX as a cash-settled derivatives exchange, in which the majority of transactions are settled financially, rather than through the transfer of physical metal. Turning to the retail physical silver market, the source report notes that current premiums at major online bullion dealers, including APMEX, JM Bullion, SD Bullion, and Monument Metals, range from $4 to $7 per ounce above the spot price for 1-ounce Silver Eagle coins. The report states that the effective physical purchase price for a Silver Eagle at current premiums is therefore closer to $88 to $90 per ounce, rather than the $83.35 spot price reflected on futures market charts. The source report references 3 specific historical episodes as precedents for the current relationship between paper market prices and physical market conditions. The first is the 2008 financial crisis period, during which the report states the paper gold price dropped to $700 per ounce, while physical premiums expanded to 30% above spot. The second is March of 2020, during which the COMEX spot price of silver fell to $11.75 per ounce. During that same period, the report states that physical Silver Eagles were selling at dealer prices of $22 per ounce, a premium of over 90% above the spot price. The report notes that major dealers across North America were backlogged by 6 to 8 weeks, that the United States Mint suspended Silver Eagle production due to blank sourcing constraints, and that the COMEX spot price subsequently rallied to $30 per ounce within 6 months. The third historical reference is the 2008 energy price environment, when Brent crude spiked to $147 per barrel. During that period, the report states that all-in sustaining costs for silver miners rose to nearly $18 per ounce, and the spot price of silver climbed to $21, at the time an 18-year high, as the market adjusted to reflect production cost realities. The report additionally references the 2011 silver market, during which the price rose from $18 per ounce in August of 2010 to $49 per ounce in April of 2011, a gain of approximately 172%, during a period the report characterizes as one of relative stability compared to current conditions, noting the absence at that time of a Middle East conflict, a global supply chain disruption, or a Strait of Hormuz closure. A fourth historical reference is made to the 2020 oil market episode, when oil prices briefly moved into negative territory before recovering to $80 per barrel, at which point silver subsequently rallied from $12 to $30 per ounce within approximately 6 months. The source report also references the GLD Gold Exchange Traded Fund, noting that it recorded outflows of $4.2 billion in a single week at prices near all-time highs, while the physical gold price remained above $5,170 per ounce despite that volume of paper selling. The report presents this divergence as a structural observation about the relationship between paper selling pressure and physical market pricing in the current environment. Turning now to the broader macroeconomic framework outlined in the source report, the current combination of rising energy prices and slowing economic growth is described in the report as a stagflation scenario, defined as the simultaneous occurrence of high inflation and low economic growth. The report identifies this as the policy condition that central banks find most difficult to address, as the standard tools of monetary policy produce opposing effects on its two components. The inflation side of the current equation is attributed in the report to the energy price spike driven by the Strait of Hormuz disruption. With crude oil above $100 per barrel, the report identifies the following cost increases as direct consequences: gasoline prices at the point of consumer purchase, diesel prices for trucking and logistics networks, heating costs for businesses and households, and input costs across manufacturing, agriculture, and construction. These increases, the report states, reduce consumer discretionary spending as a greater share of household income is directed toward fuel and energy expenditure. Simultaneously, businesses face higher operational costs, reduced profit margins, and diminished capacity for capital investment and expansion. The report identifies this combination, rising prices alongside declining economic activity, as the defining characteristic of a stagflation environment. The report then outlines the policy dilemma this creates for the Federal Reserve. Raising interest rates to address inflation, the report states, would suppress economic activity further, increase unemployment, and risk triggering a recession. Cutting interest rates to stimulate economic growth, conversely, would expand the money supply and apply additional downward pressure on the purchasing power of the currency, worsening inflationary conditions. The report cites 3 historical episodes in which central banks faced comparable policy dilemmas. The first is the 1970s stagflation period, which the report states required Federal Reserve Chairman Paul Volcker to raise interest rates to 20% to restore price stability after a decade of failed policy responses. The second is the 2008 financial crisis, during which the Federal Reserve reduced rates to zero and initiated quantitative easing to prevent a deflationary economic collapse. The third is the 2020 pandemic period, during which the report states that $9 trillion was printed over 18 months to stabilize the economy. On the current fiscal position of the United States, the report cites a federal debt figure of $36 trillion, a debt to gross domestic product ratio described as exceeding the level recorded at the end of World War II at 124%, and a Federal Reserve balance sheet reported at above $7 trillion following multiple rounds of quantitative easing. The report draws a direct comparison to 1971, when United States federal debt stood at $398 billion, and the Federal Reserve balance sheet was $65 billion. In the period from 1971 to 1980, following President Nixon's closure of the gold window and the end of the Bretton Woods system, the report states that gold moved from $35 per ounce to $850 per ounce, and silver moved from $1.50 per ounce to $50 per ounce. Regarding strategic petroleum reserves, the source report provides the following figures. The United States Strategic Petroleum Reserve currently holds approximately 370 million barrels of crude oil. Against domestic consumption of approximately 20 million barrels per day, the report calculates that the full reserve would cover 18 days of domestic consumption. The International Energy Agency member countries collectively hold approximately 1.5 billion barrels in strategic reserves. Against global consumption of approximately 100 million barrels per day, the report calculates that the full IEA reserve system, if completely deployed, would cover 15 days of global demand. The report notes that the G7 nations already drew down a significant portion of those reserves in 2022 during the period of Russian oil price cap measures following the Ukraine conflict. On the BRICS monetary and trade settlement developments, the source report cites the following specific data points. The Saudi Arabian Monetary Authority announced in 2025 that it would accept yuan for oil sales to China. The Shanghai International Energy Exchange is identified as now the second largest oil futures market in the world by volume. The Bank for International Settlements published a report in January of the current year, stating that cross-border payments in non-dollar currencies have increased by 41% since 2023. The dollar share of global reserve holdings has declined from 71% in 1999 to 58% at the time of reporting. On central bank gold purchasing activity, the report cites the following figures. The People's Bank of China has been purchasing gold every month for the preceding 16 consecutive months. The Central Bank of Russia holds 23% of its reserves in gold, up from 16% in 2020. The National Bank of Poland increased its gold reserves by 130 tons during 2025. The report identifies these as institutional reserve allocation decisions by sovereign nations rather than speculative market positions. The report also addresses the combined energy production position of BRICS member nations. Russia is identified as the second largest oil exporter in the world and the largest natural gas exporter. Saudi Arabia, identified as a BRICS member, is the largest crude oil exporter. Iran, also identified as a BRICS member, holds the fourth largest proven oil reserves. The United Arab Emirates, another BRICS member, is the eighth largest oil exporter. Combined, the report states that BRICS nations control over 40% of global oil production and over 50% of proven reserves. The report notes that the Shanghai Gold Exchange is now the largest physical gold market in the world by volume, that the Moscow Exchange has launched ruble gold futures contracts, and that the People's Bank of China is reported to be developing a yuan gold convertibility mechanism for international trade settlement. On the geopolitical implications of a prolonged Strait of Hormuz disruption, the source report provides country-specific energy dependency figures. Japan imports 90% of its energy supply. South Korea relies on Middle Eastern crude for 60% of its oil supply. European nations import 40% of their oil from the Persian Gulf region. The report states that 21 million barrels of crude oil pass through the Strait of Hormuz daily, representing 21% of global petroleum consumption. As the first trading session of the new week gets underway, the full scope of reported developments across silver and gold markets, energy prices, mining production costs, macroeconomic policy conditions, strategic petroleum reserves, and global monetary developments can now be consolidated into a final, comprehensive summary. On silver market conditions, the spot price opened Monday's session at $83.35 per ounce, declining 65 cents from Friday's closing price of $84. Retail physical silver premiums at major online bullion dealers including APMEX, JM Bullion, SD Bullion, and Monument Metals are currently reported at $4 to $7 per ounce above the spot price for Silver Eagle coins, placing the effective all-in physical purchase price at approximately $88 to $90 per ounce. The COMEX silver futures market operates on a leveraged margin structure, in which a standard 5,000-ounce contract with a notional value of $420,000 at $84 per ounce can be controlled by a margin deposit of approximately $42,000, representing roughly 10% of the contract's notional value. The COMEX has publicly stated that less than 1% of its contracts result in physical metal delivery, with the remainder settled in cash. On the energy market, Brent crude oil spiked to $119.70 per barrel overnight, before settling above $100 at the time of reporting. The Strait of Hormuz, through which 21 million barrels of crude oil, representing 21% of global petroleum consumption, flow daily under normal conditions, is reported to be effectively frozen due to military escalations. G7 held an emergency meeting at 3 o'clock in the morning Eastern Time on Monday to discuss the coordinated release of strategic petroleum reserves in response to energy market conditions. On mining production costs, Fresnillo's most recently reported all-in sustaining cost stood at $21 per ounce, calculated when Brent crude averaged $78 per barrel. With energy representing 30 to 35% of total production costs, equivalent to approximately $7.35 per ounce, the reported 28% increase in Brent crude raises the energy cost component to approximately $9.40 per ounce. The revised all-in sustaining cost at $100 oil is therefore calculated at approximately $23.50 per ounce. Fresnillo. For producers operating on forward energy contracts based on sub-$80 oil forecasts, the report estimates real sustaining costs could reach $26 to $27 per ounce for large, efficient operations and above $30 per ounce for smaller producers. The full silver production process, from diesel-powered excavation through ore processing, smelting at temperatures above 961 degrees Celsius, ocean freight on bunker fuel vessels, and final logistics distribution, is identified as energy dependent at every stage. On the macroeconomic policy framework, the report identifies the current environment as a stagflation scenario, defined as the simultaneous occurrence of high inflation and low economic growth, in which standard monetary policy tools produce opposing effects on each component. Historical precedents cited include the 1970s stagflation period, requiring Federal Reserve interest rates of 20% to restore price stability, the 2008 financial crisis response of zero interest rates and quantitative easing, and the 2020 pandemic response involving $9 trillion in monetary expansion over 18 months. The United States federal debt stands at $36 trillion. The Federal Reserve balance sheet is reported above $7 trillion. The debt to gross domestic product ratio is reported at 124%. On strategic petroleum reserves, the United States Strategic Petroleum Reserve holds approximately 370 million barrels against domestic consumption of approximately 20 million barrels per day, covering 18 days of domestic supply if fully deployed. The International Energy Agency member countries collectively hold approximately 1.5 billion barrels against global consumption of approximately 100 million barrels per day, covering 15 days of global demand if fully deployed. The report notes that a significant portion of those reserves was already drawn down during the 2022 Russian oil price cap period. On BRICS monetary and trade settlement developments, the Saudi Arabian Monetary Authority announced in 2025 that it would accept yuan for oil sales to China. The Shanghai International Energy Exchange is now the second largest oil futures market in the world. The Bank for International Settlements reported in January of this year that cross-border payments in non-dollar currencies increased by 41% since 2023. The dollar's share of global reserve holdings has declined from 71% in 1999 to 58% at the time of reporting. BRICS nations are reported to control over 40% of global oil production and over 50% of proven reserves collectively. The Shanghai Gold Exchange is the largest physical gold market in the world by volume. The Moscow Exchange has launched ruble gold futures contracts. On central bank gold purchasing, the People's Bank of China has added to its gold reserves every month for 16 consecutive months. The Central Bank of Russia holds 23% of its reserves in gold, up from 16% in 2020. The National Bank of Poland added 130 tons to its gold reserves during 2025. Historical silver price precedents cited in the source report include the 2008 episode in which Brent crude at $147 per barrel pushed silver mining all-in sustaining costs to $18 per ounce and the spot price to $21, an 18-year high at the time. The 2010 to 2011 period saw silver move from $18 to $49 per ounce over approximately 8 months during a period of European debt crisis and Middle Eastern instability. The March 2020 episode saw the COMEX spot price fall to $11.75, while physical silver eagles sold at dealer prices of $22 per ounce, a premium exceeding 90%, with major dealers backlogged 6 to 8 weeks and the United States Mint suspending silver eagle production. 6 months after that episode, the COMEX price had recovered to $30 per ounce. Country-specific energy dependency figures relevant to a prolonged Strait of Hormuz disruption include Japan at 90% energy import dependency, South Korea at 60% reliance on Middle Eastern crude, and European nations importing 40% of their oil from the Persian Gulf region. South Korea is reported to be weighing an oil price cap for the first time since 1997. Saudi Aramco raised its April oil price for Asian buyers by the largest margin since August of 2022, with earnings scheduled for March 10th. The Ras Tanura refinery, Saudi Arabia's largest, was forced to halt operations following a strike, with Aramco rerouting shipments through Red Sea facilities on Saudi Arabia's west coast and 8 supertankers already loaded this month. This has been a comprehensive Monday morning market briefing covering silver and gold market conditions, COMEX futures market structure, physical dealer premiums, mining production cost dynamics, energy market developments, stagflation policy framework, strategic petroleum reserve data, BRICS trade settlement developments, central bank gold purchasing activity, and the historical precedents informing current market analysis as of Monday, the 9th of March, 2026. All figures and developments reported are drawn exclusively from the original source material. Individuals are encouraged to verify all data points through publicly available primary sources and to consult qualified financial professionals before making any decisions related to commodity markets or investment portfolios. We will continue to monitor all developments as the trading week progresses. Thank you for watching.